I'm running over to the American Metaverse Awards where I'm giving a talk on how to raise capital for your startup or scale up in Web3 and Metaverse. We're also nominated for the best Metaverse fund, and tonight is the award ceremony, so we'll find out whether or not we get that award. Let me give a quick show of hands. Who in here is a founder or actually in the seat where you're the one in charge of raising money? All right, that's good. We got 1, 2, 3, 4, 5, 6, 7, a bunch, most of the room. That's awesome. So this will be super practical. I want to make this because this is 25 minutes. I want this as workshop style as possible, where you're getting real steps, real tangible things where you can walk away and implement it going forward. Because as Tom just mentioned, we are in an interesting environment right now where the bad news is it's a lot harder right now to raise money than in 2021, for example, where it seemed like, especially in the Web3 space, even in Metaverse, with Facebook rebranding to Meta, it seemed like money was just being thrown at every startup out there as long as it had a pitch deck. Not quite the case anymore, because when we look at the trends, both on the left side with Web3 and blockchain, oh no, that comes later. But in terms of how many deals get done and also how many exits happen, right? Both are very much like interrelated, because when VCs see, nobody has SPACs anymore. Tokens are not really launching, or tokens are trending down and down and down, right? So if the upside isn't there, why invest in the first place? So a lot of VCs were like sitting on the sidelines. They said, we're taking a pause. We're not deploying right now, which you can see on the left side how we've dramatically trailed down from the highs of 2021, where in fact Q4 of last year of 2022 was lower than even at the end of 2020, in the midst of the pandemic. And why is that? Of course, there's global macro pressures. Interest rates are going higher and higher, meaning there's more competition for capital. Because ultimately, you can put in the treasuries, you make 5% guaranteed unless the government fails, versus rolling the dice when financing is getting harder and harder. At the same time, Web3 regulatory crackdown, which is this morning where Elizabeth Warren put up an ad on her Twitter account, which she said, I am building an anti-crypto army, right? Not the best environment, perhaps, to launch a crypto token. And at the same time, we have, as I mentioned, a weak token and SPAC market. SPACs were kind of like a new thing in 2020, where people took pretty much premature companies, took them public for quick exit for the early investors. And of course, antitrust pushback, something that isn't looked at enough, where, for example, who's heard of Supernatural? I see 1, 2, right? So Supernatural is one of the biggest VR fitness companies, right? And Meta wanted to acquire them. And then the FTC said, hold up, you are building a monopoly here. We don't necessarily want that. Now, the good news is that they lost that suit, and ultimately Meta is able to move forward with that, because the problem is, look, if Meta's not the one acquiring a $500 million VR deal, who's going to do it, right? There's not that many VR players out there. And then if investors know, look, I can't even get acquired down the line, we're not going to IPO, because there's no, SPACs aren't working, bad IPO market. Acquisitions can't happen either. Tough, right? And of course, last but not least, there's a trough of disillusionment right now in a lot of these sectors to talk about, whether it's Metaverse, whether it's crypto, and so forth. But here's the good news. Good founders will keep getting funded. I'm not just talking as like a life coach or something. In the last 12 months, I myself raised over 15 million for my own firm, and then our portfolio founders raised between 50 to 100 million dollars. Again, all just in the last 12 months, all in this horrific time, so to say. Because the truth is, good news is great founders will always find funding. And so someone might sit in the crowd and say, but I'm a great founder and I haven't had luck. Well, there's a couple key pieces that a great founder knows. And so even if you are a great founder, maybe you didn't know before, after this talk you will know, which is, first, when is the right time for both you and the industry to raise money? 2 is, why are you even raising? 3, how to balance disruption and market fit. 4, where to find the right investors, and I mean the right investors. And last but not least, what is the right structure and valuation? And in today's talk, we'll dive into each of these in detail. And so let's get started. When is the right time for you to even raise capital? Now, that's a really, really core question, because essentially you are looking for an ideal overlap. You have on one side, are you and your product ready to raise capital? Number 1. And then is your industry, your sector, your category in a good spot to raise money for? X marks the spot where it's the ideal time when your product's ready and the industry's ready. Who can think of an industry that currently has a really easy time raising money? AI. There you go, right? You put on a deck, You say, I'm raising for AI, and ideally you have also a product that's ready to raise money, and you're gonna have an amazing time. There was one company we looked at, they were an AI startup, they started raising Q1, they said 15 million pre-money valuation. As the AI heated up more and more and more, they're like, you know what, 25 million pre-money valuation. Has much changed? No, but of course the market is excited right now, right? And on the flip side, of course, there was metaverse companies raising at, let's say, $200 million valuations, and if they try to raise now, they might be lucky to get 50. Right? And so the industry matters a lot, but the point is there's one thing you have control over, which is your product, and there's one thing you don't have control over, which is the industry. Now the good news is a great founder will know that if you are in an industry already that is having a moment in time, you have to squeeze that opportunity and raise as much money as possible. Right? So for example, if you were a metaverse founder and didn't raise a massive round in 2021 when Facebook literally rebranded Meta and people were throwing money at you, you missed an opportunity, right? So for example, one friend of mine, Assad, the founder of Jadu, Jadu is an AR metaverse company essentially. And in Q1 of 2022, they raised 36 million at, I believe, a 250 million valuation. It was too high for us, the valuation, so we passed, but ultimately, it was the smartest thing he could do. In one quarter, even though the company was very young, he was raised enough money to pretty much last him for 5 years, right? Others said like, oh, well, we're kind of good right now. We don't need the money right now. They waited 6 months and they realized, wow, it's a lot harder right now to raise. So when you're in that sweet spot where you are able to raise, you should raise. But that doesn't mean that even if, let's say the industry is cold, right? Web3 is a little tough right now. As long as you have a good product, you will always find money, but maybe not at the exact terms that you want it. And so here, for example, we saw the venture capital backing for blockchain, of course, massive spike in 2021. We're talking to the tune of like an 8x more amount of money coming in. And then same thing in VR. You've had 2 VR bull cycles, so to say, once in 2018, and then it completely died off in 2019. And then again in 2021. And so the good news is if in each of those cycles, if you raise like 3 or 4 years of funding, you can always survive long enough till the next cycle comes around, right? And that's really key. And one important piece to kind of like cover before we move on from the when to raise money is also you don't want to wait till you're out of money. I see too many founders, they put their head down until the final minute and then they're like, well, we're gonna run out of money in 1 to 2 months. And guess what? Your bankroll is your leverage. If you go into a VC meeting and you're like, well, you know, payroll in 1.5 months won't be going through, they have way too much pressure on you. Because ultimately then they say, okay, then let's wait a month. Because if I wait another month, now you've got 2 weeks left. And I know the valuation you're gonna give me with 2 weeks left is gonna be way lower than whatever you're gonna tell me now. The difference though is if you have 6 months, well, at this point, the VC is not gonna wait 6 months. Plus in those 6 months, hopefully you'll find somebody that says, you know what, I agree that your product has real traction, has a true north, like it's going somewhere and I want to be part of that journey, right? And so you have way more chips, so to say, on your side when you have a little bit of runway left. And if you say, hey, well, but this is my first round, I've never raised, well, at that point you should be bootstrapped. You should either be bootstrapped where you don't need money at all, or a lot of founders, they start with an initial self-funding. Maybe they put like 30,000, 50,000 of their own money, maybe family and friends, and that you should already chart out and say, okay, well, this will last us 12 months to get to the MVP. Well, 6 months before that, maybe it's time to start talking about a pre-seed round, maybe a 6 million valuation, maybe an 8 million valuation, and so forth, simply to progress to the next stage. So, which is actually really important with number 2, because sometimes I get decks in my inbox where people are trying to raise, and I can't quite figure out why are they even raising. Because either you have, for example, let's say a profitable company, and you're profitable. You don't need money, and you're not really trying to grow beyond it, so what's it for? Well, because right now is a great time. Not quite compelling. At the same time, sometimes people try to raise massive rounds. Let's say they have a burn of, let's say, 200,000 a month, and they're trying to raise, again, like a 10 million, 20 million round. And they don't exactly even outline how that burn is going to change. And so it's really important for you to be clear of like, why do I need the money? What am I going to do with it? What growth is going to come out with it? And here's a little visual that I prepared. The way to frame why you're raising. Because people make 2 mistakes. Either they're purely raising off what they have done, and they're not even painting a picture of the future. You're pretty much telling people about the business you've built. You're buying into what is today. But really with VCs, they're looking for what comes next. Like, what are we building here? And so you really need to sell the vision of like, what am I going to take? You're going to give me these $5 million. Here's what I'm going to build with it, Here's how I'm going to turn 5 million into 50 million worth of value, for example. So mistake number one is people, they only pitch the present. Mistake number two is that people pitch the future, but they have nothing to show from the present so far, because those are interconnected. And so you do use what you've done so far, but look at it as essentially like the building block on which you let your future vision rest. Because if you tell me, look, I'm going to build this multi-billion-dollar company and we're going to do this and this, but you haven't accomplished a single thing, even with the money you've raised so far, what makes me believe that you can pull that off? And so it's really important for you to essentially outline how much have we raised so far and what have we accomplished with it. Now we're trying to raise this, and here's what we're going to build with it. And a great example, one of our portfolio companies that was actually awarded to this conference, Cathedral Studios. Cathedral Studios is a Web3 game development studio. When they first came to us, it was like 7 guys living out of an Airbnb, building a Web3 game. And while all the Web3 games had fancy trailers and marketing messages and so forth, they had a live game. And so we actually play tested, and we're like, wow, this is incredible. This was already in January of 2022. It was like Unreal Engine, like high fidelity gaming. It was, like any shooter that you'd play, while the industry was used to Axie Infinity 2D crap, to be honest, And we asked them, well, how did you build this? We haven't raised anything yet. Oh, $50,000 from the founder. So with $50,000 from the founder, the team was like, X Assassin's Creed, X this and that. We're like, wow, with so little money, you will build all this. Now imagine if we give you 400, for example, our Preseed ticket was 400K. If we give you 400K, imagine what they can accomplish with that. And again, they proved us right, where they said, okay, they got the 400K, and then they got into the Microsoft Accelerator, the Amazon Accelerator, the NVIDIA Accelerator. They got a grant from IMX. They pulled off a lot of incredible things. They got like 25 gaming guilds on board. And so we said, wow, if you did that with this, well, imagine what you'll do with the next round. So now they started raising the next round, where even in this crazy environment, the first time we backed them in January of 2022, they raised an $8 million val. Now they raised it 25. So they pretty much upgraded their valuation 3 times. In a crypto bear market, in a metaverse bear market, where pretty much all gaming was going south, right? So this is a huge opportunity for you to say, hey, capital raising is really an opportunity for you to show what you can accomplish with resources, right? And so it's not just about the current round, it's also about what we've done in the past. And the moment you get the money, this is your trial to show what you can accomplish for the next round. And finally, on why you're raising, I think it's really important to quickly talk about bridge rounds too. I know bridge rounds are becoming more and more common in this current environment. Bridge round, for those that don't know, is essentially you've raised in the past, let's say at a 20 million val. This was 2 years ago. You're going to raise a 20 million again, and maybe it's not a big one. Maybe it's just enough to get you through the next 12 months or so, or the next 6 months or so. Those are generally unattractive, and you want to stay away from them as much as possible. Why? Because you're essentially asking investors to just pay for maintenance. And so, well, if the last 2 years with this burn haven't really gotten us much, what makes us believe that giving you another 12 months with the exact same burn is going to change anything at all? And so I think it's really important to control that narrative and control that messaging, that why is it now going to be different? How is the approach now going to be different if you're forced to do a bridge round? And as always, be specific in kind of what growth can it unlock. Because I talked to a founder that was in that specific situation where he's down to 2 months. We actually kind of like the company. We like the segment. It's just a segment that's kind of out of favor, like VR fitness right now. And that was a real challenge where I said, well, last time you raised money was like 3 years ago, right? And we still have virtually 0 revenue. And so sure, I can buy you another 12 months. But what makes me think that in 12 months, we're not going to be in the same situation again, where maybe now instead of 0 revenue, you've got a couple thousand of revenue, but it still doesn't cover overhead. And what then, right? If VR is still in a tough spot, then it's wind down time. And so you have to find a way to make it compelling if you're going to do a bridge round. Number 3, how do you balance disruption and market fit? That's a really tough one, because on one hand, in bull markets, people want to be as disruptive as possible, right? This is actually the important one. They want to be as disruptive as possible. They say, forget about revenue, forget about profit. It's growth, growth, growth. They want to be the market leader. And then the bear market comes and they say, well, how much money are you making, right? Are you guys saving, and are you guys, generating profit? It's about today, it's not about tomorrow. And so it seems like VCs can switch, 180 depending on where the market is at. But it's important for you to find out like more holistically, no matter the market cycle, what are you and your team actually capable of building? And what I mean by that is that, of course, the holy grail is you want to be as disruptive as possible as a VC too. You want to back the most disruptive ideas. But the thing is, not everybody can pull that off, right? At the same time, sure, you want profitable companies, but if they're already profitable today, they probably can't scale as much. And so the sweet spot is somewhere in the middle where you are disruptive, but at the same time, you're also able to already see traction today. And so I'll give you examples of each. So profitable. I've gotten tons of things in my inbox like NFT agencies or some kind of like NFT tools where they were able to show great results where they launched NFTs, they did partnerships and so forth, and they made actual revenue. But then I look at it and say, well, this is kind of a symptom of the time. This was because of 2021, and two, there's little differentiation. You're probably not going to maintain this, and give it 2 years, and there's going to be 50 competitors, and that money's no longer going to be there. And plus, what do you need my money for? If it's so profitable, can't you do this yourself? Sweet spot, product market fit. Like 2 hours ago, you guys saw Daria present from TressX. So TressX is one of our portfolio companies. And I think they're kind of really perfect at that sweet spot where on one hand, they're tackling something very disruptive, like digital fashion. But at the same time, they're already generating revenues now, whether it's from like NFT sales, whether it's from partnerships, and so forth. And so you're able to balance the two. On the far right side of the spectrum, disruptive, very easy to get wrong. Adam Draper, we co-invest a lot. He once told me, you have to be careful backing tinkerers because there can be these really bright technical minds, and they can build the future, but sometimes they get so caught up in the tech that they then actually fail to build a business, right? And so if you're going to go far out on that disruptive scale, you have to find people that can actually deliver in the end, because there's a lot of people that will make slideshows and that will make presentations and videos of to throw people on the bus. Let's say Star Atlas, for example. Star Atlas, I think, paid $5 million for a game trailer, right? But there's no game yet, okay? And so by the time they finally get to a game, they might run out of money, right? And there's many others like that. But when it comes to being fully disruptive, one of our portfolio companies we just invested in like a week ago, it's called Atom Montage. And so what they do is they essentially build an entirely new game engine, right? Where they're trying to replace the Unity or Unreal with microvoxels. And usually you'd say, well, how many people are there trying to build new game engines? Really, really hard problem to solve. That one was a little bit unique because first of all, it got introduced to me by Palmer Luckey, the founder of Oculus. And then we looked at the other backers, which is like very private round. It was the founder of EVE Online was an investor. One of the guys building Battlefield was an investor. And it's like all these people deep in the industry believe that these guys can pull it off. And they've already been building on it for, believe it or not, 13 years. And so this is a long shot, really, really long shot. But in the event that it becomes successful, I mean, this will be a deca-billion-dollar company. But I'm fully aware that there's a 95 to 99% chance that they're not going to make it. But you have to be aware that if I take such a small chance of success, you have to be the one that actually can be in that 1% or that 5%. And so for yourself, finding out where on that spectrum do you lie? What is like natural to you? And number 4, where do you actually find the right investors? It's surprising to me actually that a lot of people, there's 2 struggles people have. Either number 1, they don't know where the investors are. And I can sympathize with it because when I first started my fund, like I didn't come from finance background. I didn't come, I didn't go to an Ivy League or something where a crazy network. I think when I first launched my hedge fund, this was like 5 years ago, I knew like 5 millionaires. This is an awful background to launch a fund with, I realized afterwards, because to be an investor, you have to be an accredited investor, which is a millionaire. And so like I had to work my way through that. And I even remember like reading books on family offices, like where are these magical family offices out there, like how do you find them and how do you pitch them? But the reality is there are very simple systems in place for you to find the right people for you. And so you want to reverse engineer your investor pool pretty much, right? So if you're building a certain startup, like let's take TressX for example, digital fashion. Okay, well then look at all the other digital fashion startups, UNXT, The Fabricant, Dematerialized. There's many more, Mona token and so forth. There's like 5, 6, 7, 8, 10 different digital fashion startups. So then look at the cap table. Who invests into their round? Now you know who's actually interested and believes in digital fashion. That might be a start, right? Same thing with gaming. Who's allocated to Web3 games? Build yourself a list of all the Web3 games that got backing, find out who backed them, there's your list. These are people that are actually genuinely interested in this segment. Now, it's possible, and that's the caveat, is that if you go too niche, they might have already scratched the itch, so to say, where they say, well, like if I get pitched digital fashion right now, I already have my digital fashion allocation. I don't necessarily need another one, right? But if you zoom out a little bit and go by a broader segment, like for example, metaverse, Web3, or like infrastructure in Web3, or or DeFi in Web3, you will be able to find something, like find a good list of people that are right for you. And Crunchbase and PitchBook are two great websites where you can find exactly who backed what. And then you want to find the top 10 leads, probably initially. The space is full of follow investors. Like most VCs, they just want to follow. And you're going to probably spend a lot of time with them. So it might just be best for you to focus on the lead first. Like who can actually lead my round? Leading a round could be 30% of the size, could be 50% of the size, could be the whole size. That's ultimately the hands of the lead investor, but I would say they should put in at least 30% of whatever you're trying to raise, right? And you want to find somebody that you actually want to work with. Somebody where you see, hey, they believe in my vision. We have things that are aligned. I actually enjoy working with them. I'm going to be somewhere on the importance totem pole where if I need something from them, they will actually respond. You're not their 200th investment, right? That's also important. And ask yourself, who's able to add the most value? And then you have your list. Now the question is, how do you even approach, right? There's cold and there's warm. I think because warm seems like a lot of work, people generally go for cold, but I can tell you right now, we look at every single cold inbound email that we get in our email. We've invested in 0. And again, it doesn't mean that it's a slush pile that goes to the trash. We actually look at every single one of them, right? But there's just a different dynamic when it's a warm introduction. Now, that doesn't mean we invest into every warm introduction. Of course not. But they have a certain advantage. And so we'll go through both, because ultimately you want to start cold and find a way to make it warm. But even if you don't, there's a good way about it, right? So on the cold front, first of all, don't email the managing partner. So for example, you might want to email Ben Horowitz, or Mark Andreessen. Chances are you're not going to get through. But guess what? The job of an analyst is literally to look all day long for the right investments. So do a little bit more digging and find out, okay, who's actually in charge of that specific fund, like of their Web3 gaming fund, right? And when I say in charge, I mean in charge of due diligence. Like who are the analysts working on the specific fund? And email them. Or Twitter DM them. And in fact, before you even contact them, find out where they're most active. Maybe read some of their blog posts, like get to know them, because the most important thing is to build a shared reference. Right? That's the third thing. Where you say, hey, actually before you even say hey, you don't want to say hey, you want to have somebody else say hey for you. So you'd say, okay, who else have they backed? Maybe let me befriend one of their founders that they invested in. And maybe then if the founder says, this guy is smart, you should talk to my VC. If I go through my own portfolio, XLab came from one of my employees. Liv was recommended by the founder of XLab. MYR was recommended by the founder of Liv and XLab. Adam Montage was referred from Palmer. Essentially, I think that the math run, there's one project that was introduced by an LP. The numbers run that maybe 80% plus of our companies were actually referred by some warm lead that is either another VC, a current limited partner, meaning one of our investors, another founder, like for example, one of the founders we've already backed, because if we back a founder, we believe them to be smart. We believe them to know the industry. So if that person is smart and knows the industry and says, this person also is smart and knows the industry, we're going to give way more attention to that person. And you might find it much easier to befriend other founders than to befriend VCs, because VCs might be more, on the heels, so to say, saying like, oh, are they trying to pitch me something? And of course, an industry friend of the VC, right? So if you say, okay, you got your list of top 10 people that might back you, and you find who are the right people at that firm that could back you, and then find out, okay, who are people they would listen to? Could it be some of their friends? Could it be some of the founders they've backed? Could it be other VCs? Because one of the things that people underestimate too is that if a VC says no to you but generally liked you, maybe you didn't fit their mandate, ask them for an introduction. Some might actually do it. I've done this in the past too, where I say, look, I actually like this, but it doesn't quite fit within what we're trying to do, or the value is too high. I know people that would be right. And when you do reach out cold, right? Send the right analyst a personalized one-liner, because a lot of times we get these emails that are like novels, and it just usually doesn't work. What is so much better if we say, your goal isn't to pitch me in the first email, your goal is to get on a call with me, essentially. Or you send a one-liner that's very clear of what you're trying to do. Maybe you send another line that highlights that you've done a research saying, you know, I've noticed you've also backed this and this and this, which kind of aligns with what we're doing. Would love to give you a demo. I personally, demos are my favorite thing because, you know, with a pitch, we're just gonna talk. With a demo, I actually get to feel what you're building. I get to play test it. I get to experience it. And the demos are the fastest, lowest time friction point to identify what is legit and what is not legit, right? Because we can talk for an hour, 2 hours, philosophize. But if I spend 5 minutes with your app or your product and I see, wow, this is really, really cool, now I'm open for the next 10 hours, right? But if I see in the first, I'm like, it's not really it. It's both saving me time and it's saving you time. Plus, we're actually having a productive conversation versus philosophizing about, you know, potential market share and so forth. And the follows, of course, relationship management. You know, and relationship management matters both before you reach out, during due diligence, and afterwards. Anybody who wants to be founder, I think, should be in this for a long game. Meaning, this hopefully is your final startup, and you're going to raise another round, or maybe you start another startup, and you will be talking to these VCs again. Plus, it's a small community, so you want to be as, you know, positive as possible. And listen, I get it. I get how it is dealing with rejection because I run a fund too. As a fund, I have to raise money too. We have I think 130 LPs, which means I've probably been through. My guess is at minimum 2,000 plus investor calls, like trying to raise money, right? So I've been through 2,000 of these calls. I've been said no to like 1,800 times. So I understand that, but at the same time, I always got to put your best foot forward, right? So before outreach, you know, get to know them, do their research on them, because I know myself when I get on a call with a founder and they're already telling us what they know about us, I'm like, wow, okay. Like it's human psychology. Make the VC like you, right? Very simple. And then during the DD, be proactive, stay in touch, you know, because we look at maybe 15, 20 deals at the same time. And honestly, like sometimes 18 of the 20 might kind of get like pushed back and like we kind of forget about them because there's 2 we're really actively working on. So it's kind of your job to make sure that yours is one of the ones we're actively working on. So, you know, checking in maybe once a week, but not just pushing about how's the investment, but rather here's something we made progress on. Here's a new update we shipped. Here's something I'd like to show you, or here's a new partnership we closed, right? Make the follow-up as value additive as possible so that they know that, hey, like this train is moving with or without me. And like I want to be part of it because I see the momentum. And last but not least, after the decision is made, if they say yes, sometimes founders make the mistake, they get the money and then they kind of like become silent. Huge mistake. You know, one of our founders has done that, you know, and I give him money, silence. He needs money, very active. Every call I get, you know, he will call me 3 times a week and everything's great. And then he gets money and then he's silent again. Can be great if you're good at execution, but at the same time, you want to maintain good updates, regular updates, where if the time comes where maybe you do need a bridge round, or maybe you do your next round, you want your previous investors to do pro rata because that's also good signaling. That's the work you do ahead of time. It always comes across poorly if you pretty much ignore your VCs until the day comes when you need money again. And on the other hand, if they said no to you, right? Number 1, be professional, don't be annoying. Again, rejection happens, it's part of the game. We deal with the same thing too with our limited partners. And 2, find ways to add value, right? Like just make them part of a network. Say, like connect with them on LinkedIn, you know, maybe follow each other on Twitter, share insights with them that you actually generally feel are really valuable. And yes, they said no to you, but I think in most cases, you can still, what I do is I ask for permission to give them a brief update once a quarter. I can be like, you know, I know the fund is not the right fit for you right now, but would you be okay if I sent you, you know, a 2-minute an update that takes no more than 1 to 2 minutes to read once a quarter? Virtually nobody says no to that because again, it's 2 minutes a quarter, right? But now you have the permission where if you do make progress finally, you do have a lot of momentum, you might get them the second time around. And at least in my case, you know, I've had LPs that might have said no 1 year, but then 2 years later they came around, right? And so you don't want to close the door unnecessarily. And last but not least, what is the right structure and valuation? By the way, how are we doing on time?
5 minutes, good.
Awesome, sweet, we're good. So what is the right structure and valuation? The biggest challenge right now, let's say, is figuring out whether you want to raise equity or a token or both. And that has been an ever-changing dynamic because in 2017, for example, people pretty much only did tokens, ICOs. There was no equity behind it. And in fact, there was a movement against equity where people said, you know what, you have to destroy, you have to pretty much unwind the LLC, you have to unwind the C Corp and so forth because it makes it less decentralized. And then the bear market came around, and particularly for gaming, for Web3 games, you start having people say, you know what, actually, I want to also own a piece of, let's say, the game studio. Axie has Sky Mavis, right? And then Uniswap has Unilabs. And there's many of these places where you have a valuable token, but then also you have a valuable company. And the problem that arises with that is essentially you're serving two different lords, where the question is, who are you creating value for? Are you creating value for the token holders? Are you creating value for the equity holders? And the solution to the conundrum currently essentially is a safe plus token warrant. And the reason for that in this particular instance is that I think long term, for the sake of decentralization, every project that aims to be decentralized should only have a decentralized token with no private company. A good case study for that is SushiSwap. SushiSwap recently incorporated an LLC. It took them, I think, a couple months, and they got a subpoena from the SEC. Well, if you don't have a legal body, it's much, much harder for you to be regulated. That being said, in this current environment, most people don't want to launch tokens because of the regulatory risk. And so your best shot currently would be to raise as a company with a safe, but add a token warrant. And the token warrant means that if we ever raise a token, you also get X% of that token. But if we don't raise a token, then that thing is pretty much useless, right? So at least this way, you can align all the investors on the same page. Let's start with the entity, much, much simpler, no regulatory hassle. You don't need market makers from day one. There's a lot of resource strain that actually comes with having a token. And so, equity and token warrant is probably the best path forward. And on valuation, also, I would say trust consensus. Ultimately, you should start bold, but prioritize staying in business. Sometimes I see founders pulling numbers out of a hat where I see people with no product, no MVP, like Preseed, slap 35 million on their deck, and I'm like, yeah, that's not gonna happen. Nobody's gonna give you that, right? Because we have other companies that have hundreds of thousands of users and less valuation. And so you have to listen to the market, right? Because ultimately, valuation is merely supply and demand. Is somebody willing to back you at this valuation or not? If not, well, that does become your problem, because if you say it is worth 35 million, well, then go ahead and self-fund it, right? If nobody's willing to back it and you want to stay in business, you have to go lower and have to listen, what is a valuation that you find reasonable? And the good way to prepare for that so that you're not getting taken advantage of is, again, to do your research. What are other comparative companies at your stage in your vertical raising at? And that's pretty simple because, we see these decks all the time, so we have a pretty good feel for that, where we say, okay, we just looked at, let's say, 10 open worlds. They're on average valuing themselves here. We looked at 50 games. They on average value themselves there. So VCs have a pretty good feeling. Generally, they're not out to get you, so to say, but the way to protect yourself from them getting you is by asking multiple, right? So if you're talking with 3, 4, 5 different VCs, right, you present your valuation based on your research, and if they say, you know what, I know you in 15, but really I can, I think 15, sorry, I know you're on 20 million pre, but 15 is more realistic, and if 4 of them say that, then I wouldn't fight it. I would rather go to 15, secure the money, and move on with your life. Because ultimately, too much time also is wasted by founders, just trying to get the perfect valuation, trying to get the best VCs, and then they become professional capital raisers, essentially. And so to recap, if you want to raise money, it's important to know all the W's. When is the right time for you in the market? Why are you even raising money? Why do you need the money, right? How are you going to approach them? Where do you find the right investors, and what is the right structure for you? Because ultimately, capital raising can become a full-time job, as I just mentioned, and it really should not be, because the moment it becomes that full-time job for you, and I've seen founders fall down that rabbit hole where they say, okay, you know what, let's speed this up. You want to raise 3, let's make it maybe 2 or 1.5, or let's adjust the valuation, but let's get this over with in 2 to 3 months so that you can go back to the actual business, the actual core business of growing and building, because that is what will ultimately be your success. But even with that, enjoy it, because ultimately I think capital raising can also be a lot of fun if you approach the right way, because it's a fantastic way to build a network. That's a way for you to get into networks of other great founders that are also backed by the similar VCs. It's a great way for you to learn from VCs where, they're not just money, but a good VC hopefully has also backed a number of other startups where they learn from their mistakes. They learn from what went right there. They learn from what went wrong there. They might have strategies for you that you can't read up on the internet or watch on YouTube, right? Because that might be a secret sauce that one company used that they don't publicize, but they're willing to share with another portfolio company. And so enjoy the process, but don't make it your full-time job. And so with that, I know we're at the end of the time. I'll leave it up to Tom whether we have time for Q&A.
That was a killer presentation. I really like it.
Thank you so much.
Of course.
That was great.